Hello everyone. Welcome to cryptocurrency mobile mining and trading. I'm Dixon, and I'm excited to have you here. After countless hours of research and testing, I'm here to bring you the most reliable, real-time updates, insights, and strategies to help you stay ahead in the world of crypto mining and trading. Let's explore opportunities, learn together, and grow our crypto knowledge and profits, all from our mobile devices. Before we dive into today's big news, make sure you hit that subscribe button, give this video a thumbs up, and smash that notification bell so you never miss a crucial update. Your support helps the channel immensely, and it ensures you're always the first to know what's moving the market. Now, let's get straight to it. The crypto market has just been hit by a massive wave, and if you're feeling it, you're not alone. We're seeing the biggest losses for Bitcoin traders since the collapse of the FTX exchange. It's a significant event, and we're going to break down exactly what happened, why it happened, and what it could mean for you. In the last 24 hours alone, a staggering $2.2 billion was liquidated from the market. This wasn't just a small dip. This was a financial tremor that affected over 403,000 traders. Imagine that, nearly 500,000 traders getting wiped out in just one day. The sheer scale of this is hard to comprehend. So, what's the current price of Bitcoin? When we look at the liquidations, the data from CoinLast paints a clear picture. The vast majority of the damage was absorbed by long positions traders who were betting the price would go up. A massive $2.01 billion in long positions were cleared out. In contrast, short positions, those betting the price would fall, saw losses of around $197 million. It's a classic case of the market moving violently against the prevailing sentiment. One of the most significant single liquidations was a $36.7 million position on the hyperliquid exchange. Think about that for a moment. One trade, one person, or entity, losing over $36 million. It's a stark reminder of the risks involved with leverage trading. Market analysts at Glassnode have pointed out something crucial. Bitcoin's price has now fallen below the average price paid by active investors. This is a technical level that analysts watch closely. When the price dips below this average cost basis, it pushes the market into what they call a capitulation zone. Capitulation is a powerful word in trading. It's that moment of surrender, where many holders decide they can't take any more losses and just sell to get out. It's driven by emotion, by fear, and it often marks a point of maximum pain in the market. Timothy Messier, who is the head of research at BRN, confirmed this sentiment. He stated, "Digital gold is now in a capitulation zone, and the market is trading on forced liquidations rather than rational pricing. This is a key insight. It means the price isn't being driven by fundamental value right now, but by a chain reaction of forced selling." Messier also added that any potential recovery will likely depend on when the big institutional buyers decide to step back into the market. We need that big money to return to stabilize prices and restore confidence. If you have any questions so far, or if you've been affected by this downturn, drop a comment below. Let's discuss it as a community. And if you're finding this analysis helpful, please take a second to hit that like button. It really helps the YouTube algorithm show this video to more people who need to see it. Now, let's talk about the spot Bitcoin ETFs. These have been a huge story this year, bringing a flood of institutional money into crypto. But this week, the tide has turned. According to data from Far-Side Investors, these funds saw a massive outflow of $903 million. This is the second largest single-day withdrawal since these ETFs launched in early 2024. When the big, regulated funds start seeing money pool out like this, it sends a very bearish signal to the rest of the market. It suggests that institutional sentiment is souring, at least for the short term. So, what's causing all this pressure? It's not just one thing, but a combination of factors. A big piece of the puzzle is the broader economic picture, specifically in the United States. Recent economic data has come out stronger than expected. Normally, strong economic numbers are a good thing, but in the current environment, they've reduced the market's hopes for more interest rate cuts from the Federal Reserve. Lower rates are generally good for assets like Bitcoin, so the prospect of higher rates for longer is putting a damper on things. Kevin Hassett, a nominee for Fed chair, recently spoke about this. He warned that stopping rate cuts too soon could actually hurt the economy. He mentioned that events like the recent government shutdown could have significantly impacted GDP, and he feels it would be a very bad time for the Fed to pause. This creates a lot of uncertainty. The market is caught between strong data and warnings from economists, and that uncertainty is fueling volatility. So how are the biggest players, the smart money or whales, reacting to this? Data from Nansen gives us a fascinating glimpse into their strategies. Right now, these large, experienced wallets are 53% short on Bitcoin. They are betting that the price will continue to fall. In stark contrast, retail traders, that's everyday investors like you and me, remain mostly long. This is a classic divergence that we often see at market turning points. Interestingly, the story is completely different for Ethereum. For ETH, the smart money is 76% long, while retail traders are 93% short. It's a complete flip. This could suggest that the big players see more short-term potential in Ethereum compared to Bitcoin right now. Looking at other major altcoins, Solana has also taken a hit, slipping to around $125. Both smart money and retail traders are showing heavy short interest in Solana, indicating widespread bearishness. HYP tokens also dropped towards the $30 mark, but they have managed to stay active through consistent trading volume and token burns, which is a positive sign of a resilient community. This is a lot to take in, and it's a tough market to navigate. We've seen a massive liquidation event, panic selling, institutional outflows from ETFs, and conflicting signals from the broader economy. The key takeaway is that the market is in a capitulation phase, driven by forced liquidations. Smart money is bearish on Bitcoin, but bullish on Ethereum, creating a complex landscape. What can you do? First, don't panic. Emotional decisions are almost always the wrong ones in trading. Second, manage your risk. The scale of these liquidations is a brutal lesson in the dangers of over-leveraging. And third, stay informed. The market is changing fast, and knowledge is your best defense. That's why it's so important to be part of a community like this one. Make sure you are subscribed, with that notification bell turned on, so you get these updates in real time. Share this video with anyone you think needs to hear this information. The more we learn together, the stronger we'll be. Please leave your comments and questions below. I read every single one, and I'm here to help you make sense of all this. Thank you so much for joining me today. I know this was a heavy topic, but it's crucial to face these market realities head-on. Again, I'm Dixon, and I'll be back with another update very soon. Until then, trade smart, stay safe, and I'll catch you in the next video.